Hello, everybody. Kirk Spano, and this is Monday. So, we are doing the Retirement Income Options Program, where we will talk about a half a dozen option selling ideas that I think probably make sense for you. First off, let's take a look at the YouTube page. This is where everything goes. It's been reformatted and simplified just a little bit. We have the fundamental trend section, which will cover macro and ETFs, and then the retirement income options section, which will cover today's video. So you can find the videos here all the time. Technical analysis by Shooter and the fundies over at Fundamental Trends. Some of what he does is free to the public. Others require a membership for only $1.99 a month, and then you can get his actual trades. And then these are some of the big topics that we're covering. So there's that. This week's article covers Ford, Square, Teladoc, Warner Brothers Discovery, Paramount, Caesars, and Permian Resources. As always, make sure you understand what's in the Using Retirement Income Options article, and that will be getting updated here shortly to make it even easier to follow in the format that we're going to do week to week. I normally keep 20 to 40% of my money in cash, and I write cash secured puts against that. Why do I do that? Well, when you think about the people who have done an 80-20 portfolio or a 60-40 portfolio, meaning 80% equities and 20% bonds, or 60% equities and 40% bonds, their performance over time has been lower than the stock market. Stock market has always outperformed over any extended period of time. Well, I don't like the idea of being invested in bonds. I'm not an institutional investor that needs certainty of withdrawals, right? I'm not managing a pension. I'm trying to accumulate wealth. I'm trying to make the biggest number possible at the end of the day. Now, when I become retired, will I find some bonds to invest in? Probably not, but theoretically, somebody could. And then you'd use a bond to generate a coupon payment for your living. Here's the thing. If you generate enough wealth, if you make enough money, if you're sitting on 4 or 5 or 6 or 8 or $10 million at retirement, why on earth would you ever invest in bonds? You essentially have won the game, and you don't need the certainty of bonds. And weirdly, the certainty of bonds isn't that certain. The one thing that is certain about bonds is that they will almost always break even with inflation or lose to inflation. They almost never beat inflation. The only time that bonds beat inflation is, and this is counterintuitive for most people, is when interest rates are falling. So if you can lock in, say, the 30-year bond rate right now at 5%, and the rate goes down to 4, and inflation is 3, your coupon beats inflation, but the capital gain on the drop in rates from 5 to 4 is an added kicker. So about the only time I would ever consider buying a bond is if I can lock in a really high interest rate. The other time I have bought bonds is when the high yield market gets destroyed. And there are companies out there that you know are going to stay in business and pay their debts, but you can buy the bonds at half price or less. The best trade I ever made is when I bought Chesapeake Energy bonds at like 27 cents on the dollar. Companies started to do well. The bonds went back to over 90 cents on the dollar. I sold them, tripled my money. And weirdly, the company went bankrupt anyway down the road. I would have ended up with shares in the new company had I kept those bonds. I ended up with a triple on my money, and I was okay with that. Chesapeake Energy has since rebounded pretty well since their bankruptcy. Now, back to selling puts. Why do I do it? I do it because if I can keep 20 to 40% of my money in cash, that reduces my equity risk, even if I'm selling puts on equities. Why? Because when I sell a put on a company like Ford, I collect a premium, and I generally get the stock at a lower price in the future than it was trading for today. Now, in the case of the trade I'm going to show you right now, that's not how it works. I'm actually going to sell a put at the money or slightly in the money in the case of Ford because it's so cheap. But usually, what you would do with a stock like Ford that's trading at a little under $10 a share right now is you would sell a put at $9 or $8 and be obligated to buy it if it fell down to that price in the time frame of your contract, of your option contract. Ford is so cheap right now that, one, you should own it, and two, if you want to own a little bit more and load up on a premium that basically gives you a dividend payment up front without having to own the stock, and if you do get the stock put to you, you get a lower net price, you can do that right now. So here's the trade, and here's why I want to do it. Ford has come to a deal with the UAW, and it's a really good deal for everybody. The reduction in their gross margin is like 60 basis points, so well under 1% over the next 4.5 years, and it secures their workforce. During the next 4+ years, Ford is going to make the bulk of its transition to being an EV company. Coincides with that 26, 27 timeframe that we've talked about since CES 2020. So we've been talking about EVs ramping up in sales in the United States in 2026 and 2027 since the Consumer Electronics Show in 2020. So those of you who have been with me that long know that that's what I've been saying. And right now, EV sales in the United States are upper single digits and starting to ramp up because of where the factories are and what's getting built right now with batteries and everything else. Time frame for all the things that come together to increase EV sales is exactly 2026 and 2027. By then, we're going to have a new generation of EVs out there, and you're already starting to see them. They're pretty impressive with higher ranges, lower prices, tax credits, all because the factories are getting built for the EVs. The assembly lines are getting better, the machines and the people. The battery plants are being constructed. The lithium is being pulled out of the ground. There's new chemistry for batteries that's better, and that's moving really fast. And there's plenty of semiconductors all of a sudden, and more coming as Intel finishes up their plant, which is not too far away from the new Ford plant. So in 2026 and 2027, you're going to see EV sales, if they're not already over 10% in the United States, jump significantly above 10%. And one of the reasons that people miss of why that will happen is the simple fact that fewer gasoline cars will be for sale. That simple. It is that easy of an equation. The car companies are simply making fewer gasoline vehicles, and the way the regulations are written in 26 and 27, it becomes almost impossible for them to sell as many internal combustion engine vehicles because their fleets would not meet mileage requirements anymore. So you will see in 2026 and 2027, EV sales jump to over 20%. I think we'll make a run at 30% by then. By the end of the decade, clearly be over half of new car sales will be EVs, and I think they'll make a run at 80%. Now, what does this do for a company like Ford? Well, first of all, it increases their net margins because the net margins on EVs are higher than the net margins on internal combustion engine cars by quite a bit. Tesla has proved this. So let's go back to the UAW deal for a second. Ford's margins are now set up to beat expectations. Why? Because everybody thinks that the margins will be lower because of the UAW deal. Oh my God, those people are going to make almost $100,000 a year building cars. Yeah, I think it's kind of funny. They're not making a lot of money. That's good, but I know half of you listening wouldn't go and work for $42 an hour and work that hard. So you take a look at this deal and you go, okay, if they're going to lose 60 basis points on margins based on the current business mix, but we know that margins are going to go up 2, 3, 4 points because of the EV sales, but they're telling everybody margins are going to go down, they're setting themselves up for beats. It's managing expectation. Now, some of the things I've said about Ford in the past continue to be true, but because people think of today as today and forever, rather than tomorrow as more of a part of forever than, today and yesterday, as the company sells more EVs and shuts down its internal combustion engine factories, that frees up a lot of real estate. We know there's a shortage of industrial real estate in the United States. So either Ford can sell that real estate or use their fourth industrial revolution technology, which during COVID in 3 weeks was able to produce ventilators, and turn it into some other business lines, joint ventures, military industrial complex, whatever, or a little bit of both. There are hundreds of billions of dollars of business that Ford can do based on their footprint and their technology and their connections that the stock market assigns no value to, because what do we know about 90% of stock market investors? What don't they do? It's a functional impairment that most of them have. They can't read. They say they can read, but I don't know. I'm not so sure that's true. And if they can read, they choose not to. You know, TikTok is too entertaining. So what I want to do here, I actually have it up over here. Let's take a look at this chart. It was stuck in this range with one breakout to the top for a long time, right? Now it's broken all the way down to the price it was at just before the financial crisis. Do we expect there to be a financial crisis? Probably not. We've discovered the manna from heaven, quantitative easing. And next year, they're going to have a new magic trick of doing quantitative tightening and quantitative easing at the same time. They did the test run this spring. So the odds of the commercial real estate loans sinking the regional banks is slim, and of that manifesting into something else are slim. Doesn't mean impossible, but the probability is that the Fed just pushes regional banks to merge in return for giving them access to the Fed window in a more expanded way. Hey, the Fed window is really for big banks, so why don't you guys, marry a neighbor and become a big bank? That's how it's going to go down. How does that affect Ford? Well, people need interest rates to be at a certain level. Buy cars because nobody can actually afford to pay interest. Not you, not me, not the government. So interest rates probably come down, at least on the short end, next year. That means your 5-year auto loan, instead of being 8.5%, probably drops back down to 5, 4, whatever. And that's good for car sales. That's good for Ford. So when this price falls off of a cliff like this, because we are in a low liquidity market where naked shorting is still allowed, although we know that that's coming to an end as well. And you have a bunch of traders running around posting charts in chat rooms that they can't explain because they copied it from somewhere but want to take credit for themselves. There are a lot of traders out there, and you find them on Reddit, you find them everywhere. And they talk their shit about stocks, about companies, because they're talking their book. It's the oldest game in town. They say half-truths, just like politicians, because a half-truth is easier to believe than a full lie. We've all pretty much figured out what a big lie is, and we don't listen to those. But if there's an element of truth, we'll believe it, even if it's fundamentally wrong. It's actually a concept from rhetoric. So back when I was studying pre-law, one of the things they taught you was, well, if you need to argue against something, make sure you give a point, right? Make sure there's a little bit of something in there that makes people think that you're not just blowing smoke up their ass. And right now, I'm telling you, the shorts in this market are blowing so much smoke up people's ass that it's coming out of people's ears. Because as the stock prices go down, they start to panic, just like they always do. Say, oh, something must be wrong. It's the end of the world. War in the Middle East. Yeah, Jesus Christ, when hasn't there been war in the Middle East? Russia, China, oil's at $90 a barrel. Look, just look at the chart and think this through and understand the business the Ford does. And understand, and Charlie Munger talks about this all the time, there are parts of the business people assign zero value to, probably because they don't understand that it's even there. Most people who are selling Ford stock are either shorting it and they won't be able to borrow the shares, which means there will be a squeeze at some point, or they're just panicking because they don't know shit from Shine or Shinola. Depends on what side of Milwaukee you live on, how you say that. That'll be a joke that Jolene appreciates. And they panic sell. So this is an opportunity for you to get one of America's great brands in a business transition that's going to be very lucrative on multiple fronts for cheap. And by the way, if you buy Ford today, you'll get a 6% annualized dividend. Now, if you sell the put that I'm going to suggest, you'll make 7.5% in 3 months. And that's not so bad. So here's what I would suggest that you do. Sell the $10 January puts. That's a little bit in the money right now, right? Normally you sell puts out of the money so that you get a lower cost basis. But $10 minus 75 cents gives you a net cost of $9.25 if it's put to you in January, which is pretty good. It's currently trading for like $9.80. Your annualized return on selling this put is over 30%. You make these types of trades once a quarter. That's all you have to do. And you can make an easy double-digit return over time against that 20 to 40% of your money that you're keeping in cash. Now, if you don't have a 6-figure account yet, this is hard for you to do. So don't bother. Just own the stock. Buy enough stock and QQQ and a couple other ETFs so that you get to 6 figures as quickly as you can. And then you can start doing this stuff for effect, right? You ever watched the movies? Fire for effect. Well, the effect of me doing this on 6-figure and 7-figure accounts is that really no matter how volatile the market is, because I constantly have premiums coming into the account, the next time it goes up, I make money because I've bought some stock. Or as the money drifts up, as the account drifts up, as the market drifts up, I just keep piling up cash. So when it comes down, I can buy more stuff. So rather than having 20% of your portfolio in bonds or 40% of your portfolio in bonds, keep it in cash and sell puts against the stocks that you wouldn't mind owning a little bit cheaper, and do it over and over and over again, because these puts will expire about 3/4 of the time without you having to buy the stock. Why? Because the stock market goes up about 3/4 of the time. And if you use these charts, it should be no sweat to have that happen. So I did the typical screening using TradingView, which everybody should own TradingView. It's such a good system. I was goofing around with the community stuff last week. I started following some people on here. Some of the editors' picks ideas here, just for the sheer educational purposes, are worth your time. If you're really going to manage your own money and you're not on TradingView a few hours a week just looking at the ideas, trying to understand what they're talking about. And remember, you should have all already read that one book on trading, Getting Started in Technical Analysis. It's worth your time. It'll make you money. It'll get you to 7-figure. Just stick with the editor's picks and what's popular. That's all you need, and you'll learn. All right. So Ford. We'll go over to Ametis. Ametis announced a $150 million deal in India today. $150 million. They just got $53 million. I hope it's starting to become apparent to people what I've been talking about with Ametis. Somebody was shooting off their mouth the other day. Oh, they might not be profitable for another year. Who gives a zuck? Learn what the business is doing. Understand the CapEx cycle. Try to figure out the financing as best you can. And this is where people get things wrong. The economy and companies, they do not and should not manage their money the same way you manage yours at home. It's different. They have access to other capital that you don't. So when you hear somebody sitting at a bar or at a family party or where, the government runs a deficit, I couldn't run a deficit. No, you're right. You can't, because you're one dude who doesn't print money, who doesn't control the economy and have a military and own millions of acres and have resources all over the world. No, you're just a dude. And it's great that you got a family and a house and you work hard, but don't project onto the economy or a company your financial experience, because it's limited. So with the Ametis, in the space of a month, they did $200 million of revenues. The market cap of the company is below that. Very similar to Spire Global. You have micro caps and small caps out there right now that, because people are scared and because the Federal Reserve has been contracting liquidity, because the shorts use Reddit and their chat rooms to conspire to short things, because naked shorting is still legal. It's not really legal, but it's nobody enforces anything. They can beat these stocks up. But we are getting very, very close to a couple seminal events that are going to cause some of the biggest short squeezes in history on micro cap and small cap and mid cap stock. First, and I know some of you have heard this and some of you haven't, so I'll repeat myself. There is a federal court ruling, and it's got to go through the appeals process. I believe it was the Circuit Court in California that said brokerages that allow naked shorting by essentially not enforcing the rules on borrowing shares are liable for the damage done to investors and companies. What does that mean? It means that the brokerages have known there's been naked shorting. I mean, we can measure it. We see the failures to deliver. And if that causes damage to an investor, to a company, now the brokerage is liable. Basically saying, hey, you allowed this guy to short a stock without borrowing it somewhere else, which is what you're supposed to do. You can't short a stock if you don't have access to the stock. You have to borrow it from somebody who owns it. And the brokerages knew that it was going on. They did nothing about it because they made a lot of commissions and fees by allowing it to happen. And now a court has said, well, you're liable for damages if you allowed it. And the Securities and Exchange Commission is trying to crack down on it, but in their typical half-assed, don't really know what they're doing sort of way, haven't done a good job. The other thing that's coming is a more liquid market. How do we know that? Because there's always a more liquid market around the corner if the current market is not liquid. And as we've talked about over and over again, quantitative tightening has taken liquidity out of the market to the tune of $1 trillion in the past year. Next year, again, as the banks transition back to being supporters of the Treasury market. And as they merge, and as the Fed helps them through the commercial loan crisis, the big wall of debt that's coming, trillions of dollars, the Fed probably continues with quantitative tightening over there in the Treasury market, quantitative easing with the banks, who end up buying treasuries, right? Talk about a circular bioeconomy. What does that do for a company like a Metis or Spire Global or Square or any of these companies that have been getting shorted? Combination of brokerages putting the screws to naked shorting and the market becoming more liquid is going to push a lot of these stocks up a lot. So again, I implore you, expand your small cap holdings. Not an index, not an ETF. You need to buy a basket of about a dozen stocks and know them well. But with a Metis, just like with Spire Global and others that we've talked about, you are seeing the end of the downtrend and the beginning of a new uptrend because the businesses are doing that well. Some investors are finding them already. The negative things that have been influencing them are going away sometime in the next year, probably by the first half of next year. And that will do very well for them. So with a Metis, stock is trading a little bit under $5. I think you can sell the $5 put for January. You're going to get well over $1, right? Yahoo for your shortcut. Sell the $5 put, you get $1.25. It means your net cost on Metis would be $3.75 if it got put to you. $1.25 in the $5 that you're holding in cash, right? Because that's what secures the put. It's a 25% gain in 3 months. Annualized 100%. Can you dig it? Square. Another one of these charts. Way below bottom fishing, right? Up here, when I told people that the stock price was going to get down here again, no way, Spano, you're out of your mind. You're insane. So now we're down here and I tell people to buy it, but it might go lower. Oh, can you feel my pain? So here's one, and I'm selling January puts and everything. I want to get into next year. I don't want to go much longer than that. Look at this line here. It's at its 2020 low again. Buy Square and sell cash secured puts, $40 cash secured puts for January. Thank you. And you get almost $5. Well, let's say it's a little bit less. Let's say you get 450. Say you get 440. That's 11%. 480. That's 12%. Less than a quarter. So you annualize it, rounding up. You're looking at around a 50% gain if this share price goes up and it's not put to you. Or you just end up getting Square for almost $35 a share. I'm okay getting more at $35 a share. I'm okay having an annualized return on my money of around 50%. I can take either. Teladoc, same thing. Look at all these companies just falling into the oblivion zone. These are Armageddon zombie apocalypse prices. You should be buying these stocks. You should be selling the puts at the money or slightly in the money. Paramount, 2020 pricing, almost financial crisis pricing. Did you see the news on Paramount this week? Anybody read it? What did we find out? We found out that Sherry Redstone is willing to sell at a price. There you go. Sherry Redstone is willing to sell if the price is right. You know what I think the price is going to be? A whole bunch of shares of Apple. That's what I think. To me, that's the smartest deal they can make. So we'll see. Warner Brothers Discovery. I've been looking at their new app, and I will tell you what, they are positioned to stay on their own if they want to. And the strikes have been good for them. I'm not sure if they're going to get bought out or not, but the deal that makes sense for them, and the one that's rumored, is CNBC Universal. Why? Because nobody has Peacock, right? Peacock has never become a good streamer. And Comcast, that's who owns CNBC Universal, Comcast is getting a gigantic payment from Disney for Hulu in January. Maybe sooner, it might be sooner, but by January at the latest. Disney is selling their Indian assets and other domestic assets to pay Comcast for Hulu. So Hulu and Disney and ESPN are going to be one of the mega networks. Comcast is already global, but their streaming hasn't been good. They can buy Max, and all of a sudden, they have everything they possibly could use. They'll have overlap with CNBC and CNN, but here's the thing. CNN is very well respected around the world. Because of domestic politics, we shit on it. But it really is a great news network. You combine their resources with NBC's, use CNN for international and global news, and use NBC for the things that they use it for now. And all of a sudden, you have a streamlined powerhouse in news. You have the combined sports assets of NBC, TNT, TBS. All of a sudden, Universal Theme Park gets all the DC characters, right? Not saying it's going to happen. I'm just saying. So when the stock is this cheap and you're whining because, oh, we started buying it at 17, man, and now it's 10, you buy more and you sell puts at the money. Caesars is a little different. You know that this one is near and dear to my heart. I've made money on this stock. I've gambled in the casinos, and I've even got food poisoning at their hotels. This one isn't ready yet. Still in that chop. It hasn't done that thing that all those other charts have done, has it? Will it? I don't know. But I will tell you this. It's not dirt cheap yet, but if we get a price down here, all of a sudden you go, oh, what always happens after the casino stocks crash? And people go back to the casino to make sure they're okay. So if this stock gets down to 30-ish, right, $10 more away, all of a sudden it becomes pretty interesting to buy or sell cash secured puts on. Not ready. Here's a different type of chart. This one's been going up. We've owned Permian Resources since it was what, $8 a share in here, right? Here's the nifty thing. And I was looking for some information on their Earthstone deal. So Permian Resources bought Earthstone a couple months ago. And they did it because the enterprise value divided by the EBITDA was among the lowest in the industry. Weirdly, and I'll put this chart in an article, Permian Resources has a pretty low valuation as well. So Earthstone's valuation was really low. Permian Resources valuation is kind of in the middle. The only stocks in the oil patch getting big valuations have been, Chevron and Exxon, Occidental to a lesser extent. This is one, even though it's not cheap, it's cheap relative to its actual business value. It probably should be in the 20s right now if valuations were historically normal. And I'm not positive that we ever get historically normal ever again in the oil patch. So we should apply some sort of a discount. But you can sell the puts on this because it just keeps drifting up. And what does that mean? It means that you just keep collecting premium, right? So if you own some shares, which I think you should, on the idea that they probably get bought out, they're now the 5th biggest producer in the Permian. They pay a dividend. They're buying back shares. They had to issue shares to buy Earthstone, and then they turn around and buy shares back. The stock probably gets bought out in the 20s, which is what I've been saying for a pretty long time. I think it might get bought out in the 30s now. And that's if they get bought out. If they don't get bought out, they're just going to keep buying back shares and increasing this dividend. So suddenly, now that Hess got bought by Chevron and Pioneer, which is huge, got bought by Exxon, making Exxon by far the biggest producer in the Permian, above Occidental and Chevron. Then these guys are 5th. And I'll show that chart too. I've had a Hart Energy subscription forever. They talk about the energy transition. So I'm going to give you some things from here. But this tracking of the energy transition by Hart Energy, it just shows you how fast things are moving. So these companies that are involved in the energy transition and the consolidation of the oil and gas industry, they're all going to make a fortune. They're all going to make a fortune. So sell puts on Permian Resources because they're just going to keep rising. And if it gets put to you, that's okay because they have a good business and they'll probably get bought out. So you either win or you win. So if you sell the January $14 puts for about $1, about a 7% return in about a quarter, annualized about 30%, and you might end up owning shares at a net cost of about 13, which, based on the direction of this chart, doesn't seem like such a bad thing, does it? And given what's going on in the Middle East, I really don't think oil is going to have a problem in the next year or two. 26 and 27, we'll see. But by then, this might have been bought out by, ConocoPhillips or something. So ConocoPhillips is the one that everybody thinks is going to make an acquisition next. And it makes sense because they're the ones that got the deal from the government in Alaska. So ConocoPhillips, Exxon, and Chevron have essentially become the Strategic Petroleum Reserve. And they're going to keep acquiring assets. I would imagine there'll be about 4 or 5 players in the Permian Basin in the next 5 years. It will be Exxon, Chevron, Occidental, ConocoPhillips, and we'll see what happens. EOG, Devon, there's a bunch of companies that can merge, and we'll see how that goes. But that means that Permian Resources is a great buy, and it means Occidental is a great buy. Haven't featured it in this one, but if you notice the headline, Berkshire bought more shares. I've been telling you for weeks and weeks, buy more shares of Occidental. All right, I will finish the article and get it published. Everything here is worth your attention. Ford, Square, TDOC, Warner Brothers, Paramount. This one's not ready yet, but I wanted to show it to you and Permian Resources. All right, take care.